Happy Tuesday, everybody. Welcome back to Tip Tuesday. Hi, Ryan.
Everyone, happy Tuesday.
Ryan, we have been receiving a lot of questions about assumable mortgages. Can you help our audience understand what the process is, what is it, how it works, all the things today?
Yeah, we were getting a lot of questions, and a big reason why is because of interest rates, of course. At the end of 2021, 30-year fixed rates were averaging a 2.875. And right now, they're at about 20-year highs. They're averaging about a 7.5. And with such a quick jump in rates, assumable mortgages really have gotten more and more popular where people weren't talking about them, years ago. So an assumable mortgage is when a home buyer purchases a home from a seller, but also takes over the seller's mortgage. So if the seller purchased the home in 2021 and has that, 2.875% rate, you could get that rate instead of today's rate. So amazing deal, right? Like too good to be
Yeah.
true. So there are a few things to know about it. One, not all mortgages are assumable. For instance, there's a lot of conventional loans out there that have been closed in the past few years, and conventional loans aren't assumable. But government loans like FHA, VA, or USDA can be. But number two, that the seller's lender still has to get you approved for the assumption. So the buyer still needs to qualify, with credit and income, and the current lender does need to agree to the assumption, really. But number three, probably the biggest hangup, and why we don't see more of these, is the down payment. So let's just say, for instance, you're buying a home for $400,000, and you want to assume the seller's loan, and let's just say it's like 250,000 is how much they have a loan on the property. In order to take it over, you do need to come in with that difference between the sales price and the loan. So in this case, it would be about $150,000. That's much larger compared to standard mortgages, which could be as low as 3% down if you're not doing an assumption. So, if you really want to go this route, you could look at other options to help with that large down payment, which is typically needed, like a second mortgage or a gift. But you'll still probably need 10 to 20% down, even with a little second mortgage to help out. So, just to summarize, assumable mortgages are fantastic, especially with such high rates right now, with where rates were years ago for people who want to sell. But not everybody qualifies really. And the biggest factor to consider is that large down payment needed.
And are there certain requirements, income, credit score, things of that nature that come into play with assumable mortgages?
Yeah, yeah. So the lender that's really transferring the mortgage, that's going to process the assumption, they still want to make sure that you do qualify. So they will look into your credit and income. So it's almost qualifying like a normal conventional FHA or VA mortgage. So yeah, they'll look at your credit, they'll look at your income, assets, just to make sure you qualify.
Very good. Well, Ryan, great information. Yeah, thank you for the clarification because this can be confusing to a lot of folks. So thank you guys. If you have any questions about assumable mortgages, reach out to Ryan or I, and we'll see you next week.
Bye,
Bye,
everyone.
guys. Bye.